Navigating the tax terrain. Unraveling the tax implications of capital gains and losses in investments. In the labyrinthine world of investments, the allure of profits comes hand in hand with the complexities of taxation. Capital gains and losses, the yin and yang of investment returns, cast a significant shadow over the financial landscape. Understanding the tax implications of these gains and losses is paramount for investors seeking to optimize their after-tax returns and navigate the intricate web of tax regulations. Capital gains unveiled. Asterisk. At its core, a capital gain arises when the sale price of an investment exceeds its original purchase price. This can stem from the appreciation of stock prices, real estate values, or the sale of other appreciating assets. Capital gains are generally categorized into two types: short-term and long-term. The holding period determines the classification, with assets held for 1 year or less considered short-term, and those held for more than 1 year classified as long-term. Taxation of short-term capital gains. Asterisk. Short-term capital gains are subject to ordinary income tax rates, which can be significantly higher than the rates applied to long-term gains. For investors in higher tax brackets, the tax bite on short-term gains can be substantial. The Internal Revenue Service, IRS, aligns short-term capital gains with the taxpayer's regular income tax brackets, leading to a tax liability that mirrors their overall income tax rate. Consider a scenario where an investor realizes a $5,000 short-term capital gain. If their regular income tax bracket is 25%, the entire $5,000 gain would be taxed at this rate, resulting in a tax liability of $1,250. This stark contrast to long-term capital gains taxation emphasizes the importance of strategic planning to minimize the impact of short-term gains on after-tax returns. Tax advantage of long-term capital gains. Asterisk. Long-term capital gains enjoy a preferential tax treatment designed to incentivize long-term investment. As of the last knowledge update in January 2022, the tax rates on long-term capital gains are 0%, 15%, or 20%, depending on the taxpayer's income. These rates offer a considerable advantage compared to the ordinary income tax rates applied to short-term gains. For example, if an investor realizes a $5,000 long-term capital gain and falls into the 15% tax bracket for long-term gains, the tax liability would be $750, significantly less than the tax on an equivalent short-term gain. This tax advantage underscores the importance of adopting a buy and hold strategy, allowing investors to benefit from favorable long-term capital gains tax rates. Offsetting gains with losses. Asterisk. The investment journey is replete with peaks and valleys, and investors may encounter periods of market downturns resulting in capital losses. The silver lining lies in the ability to offset capital gains with capital losses, a strategic move that can mitigate tax liabilities. If an investor incurs a $3,000 capital loss and realizes a $5,000 capital gain, the net gain subject to taxation would be $2,000. Furthermore, any excess capital losses beyond the $3,000 deductible limit can be carried forward to offset gains in future tax years, providing a valuable tool for tax planning. Asterisk. The role of tax loss harvesting. Asterisk. Tax loss harvesting is a proactive strategy wherein investors intentionally sell investments at a loss to offset capital gains. By strategically realizing losses, investors can optimize their tax position, potentially reducing or eliminating capital gains tax liabilities. For instance, if an investor has a $5,000 capital gain in one investment and holds another investment at a $4,000 loss, they may choose to sell the losing investment to offset the gain. This thoughtful approach to tax management is a testament to the importance of integrating tax considerations into broader investment strategies. The complex world of wash sales. While tax loss harvesting is a valuable tool, investors must navigate the rules surrounding wash sales. The IRS prohibits investors from repurchasing a substantially identical security within 30 days before or after realizing a loss. Violating this rule nullifies the tax benefit of the loss, adding a layer of complexity to tax planning. Consider an investor who sells a stock at a loss and then repurchases the same stock within the 30-day window. The IRS would treat this as a wash sale, disallowing the loss for tax purposes. Investors must tread carefully to avoid unintended consequences and ensure compliance with tax regulations. Inherited investments and step-up in basis. In the realm of estate planning, the tax implications of inherited investments add another layer of complexity. When an investor inherits assets, the cost basis of those assets is stepped up to their fair market value at the time of the original owner's death. This step-up in basis can have significant tax advantages, as it reduces the potential capital gains tax upon the subsequent sale of the inherited assets. Consider an heir who inherits a stock with a cost basis of $50 per share. If the stock's value has appreciated to $100 per share at the time of inheritance and the heir later sells it for $110 per share, the capital gain is calculated based on the stepped-up basis of $100, resulting in a lower taxable gain. Conclusion. In the intricate dance between investments and taxation, the implications of capital gains and losses shape the financial landscape for investors. Strategic tax planning, thoughtful consideration of holding periods, and the judicious use of tax loss harvesting are indispensable tools in the investor's toolkit. As the tax code evolves and market conditions fluctuate, investors must stay abreast of changes and adapt their strategies to optimize after-tax returns. Navigating the tax terrain requires not only financial acumen but also a proactive approach to integrate tax considerations seamlessly into the broader framework of investment decision-making.